Bismillahirrahmanirrahim. Assalamu alaikum. Welcome to Mastering Accounting Skills. Today our topic is profit and loss budgeting and variance analysis. Budgeting is an essential management tool that allows business owners to monitor the financial impact of their business decisions and operational plans. A profit and loss budget is a month-wise one-page summary of expected income and expenses for the year. It is based upon prior year's monthly profit and loss statement. You can revise the monthly figures of sales and variable expenses if there is any change in your next year plans. Identify and document all assumptions that you have made during the preparation of the budget. Why we do budgeting? Budgeting helps you control your spending. Budgeting keeps you on track for your financial goals. Budgeting keeps you organized. Budgeting helps you to avoid the debts. How to plan a budget? First of all, you need to collect your prior year's actual profit and loss statement. This is the profit and loss budget working sheet. So here we have our last year sales, cost of sales and all the expenses and the year-end profit. Okay, so we are going to work on this to prepare our next year for the 2021 budget. First of all, you need to go and create the monthly average, because we are going to plan the budget month-wise. For each month we need to plan that how much we will sell and what will be our expenses. So now we need to create the average sales for the last year. Sales divided by 12. Okay, so this is our average sales, and how much our average cost. We will copy the same formula throughout this column. Okay, so now after calculating the average monthly sales, monthly cost of sales and all the expenses for the month, we have it is showing that we have 7% net profit and 25% is the gross profit. If our gross profit is 25%, so definitely the cost of sales will be 75%. Okay, now we need to plan all our expenses. So what we do, the expenses as it is, just copy and select all the columns till December and make paste is special values only. Okay, so we have all our expenses based on the last year. Now we need to go and we need to plan our sales. For planning the sales, each company they have plans that they are going to increase their sales volume. So after discussing with the sales team, sales manager, this company has decided that this is the sales forecast sheet. Okay, we have make the forecast monthly customer wise sales targets or monthly area wise sales target. So here also again we have the last year's sales for each. This is customer wise. Okay, for each customer we have this much sale for annual sales for the last year, and total 3.3 million. Now we have calculated here the percentage that this customer, how much percentage it shares for the total sales. So this how we calculated sales for this customer divided by total sales, and to make it absolute value, just we will press 4. Okay, so it will give me that 23% of the total sales this customer share. So this just we will copy it till end. So like this it will give. Now when we have a meeting with our manager, our company manager, and we plan that okay, we are going to increase our sales volume as compared to the last year. So we are going, each company has plans, either they are going to induct new products, or they are going to go to sell in the new areas, or maybe they are going to increase their sales force, hiring 2 or 3 more salespersons. So as per their plans, this company has forecasted that okay, last year we have the sales 275,000 was our average, but in the next year we have planned that we are going to make each month sales 325,000, and this, then we will make the formula here. Okay, this sales, total sales forecast, again to make absolute value, press F4, multiply by this 23%. Okay, so in each month like this, each customer will give us the sales. This is our target customer wise. So same we can make it area wise, all the cities we have here and their sales for the last year we calculated the percentage, and then we apply the formula 325. Like this you can also plan product wise, you can also make your sales target. So this sales figure 325,000, after discussing and finalizing with our sales team, sales manager, after finalizing all the policies, we have finalized okay, we will sell in Jan this sales. Okay, then drag this till the end of the year. So for each month our sales is coming from the sales forecast sheet. Then we need to see how much will be our cost of sales. So it is coming here 75% was our cost of sales. So what we will do, sales multiply by 75%. So this will be our cost of sales. Okay, just drag this formula till the end December. Now we have here our sales, cost of sales in our P&L budget. Okay, this is 25% gross profit as per the previous year. We make it this sales forecast and cost of sales, and we have the gross profit for each month. Now you see, we need to review that from all of these expenses, what are our fixed expenses. They are not going to change as per the sales volume increase or decrease. There is no effect on the fixed cost, and there are some variable expenses also. Okay, so rent, we are not going to take any big building, same area we are going to take, so there is no change in the rent. Okay, and the government fees also there is no change. Regarding the salaries, we have here our salaries budget for the next year we created. Okay, so how much it was for the last year, 25,850. So here we have the salaries sheet same as above. If we have any plan, okay, we are going to hire a new sales rep. Elena, we have this name. Okay, and make it Selena. So this is our sales rep. The management decided, okay, to increase the sales, we are going to hire a new sales rep. How much her salary will be? 1,200. Okay, so like this we have changed this, and this change will come to the P&L budget. Okay, here we are not going to take the same figure as per previous, because we have changed our plans for the salaries. We are hiring one new guy. So come here and take this salaries budget For the Jan we have this much expense. Okay, now go and drag this formula till December. Okay, then government expenses, these are also fixed. Our license fees and other things, they are not going to change. Regarding the employees end of service benefits and the utility bills and the petrol expenses, how we will change all these figures, how we can have this correctly. So to get a perfect idea, we are going to see that how much sales we have increased. So how we can see that this is our sales. We forecasted 325,000. Minus how much it was previously. It was 275,599. Okay, divided by this month sales forecast 325,000. Calculate the percentage. 15%. So our sales is increased 15% by 15%. Okay, so what we will do, we will increase all other variable expenses by this figure. How it will be? This is our utility expense, multiply by 115%. Okay, we are going to increase by 15% this expense, and we will copy this formula for all other expenses also. Okay, so now it has changed. What we will do, we will copy this formula, the values, paste values. Okay, so all these expenses, so like this we are going to forecast. We have increased our sales with 15%, so we need to go and increase the variable expenses also by 15% to go to a perfect estimate. Okay, so like this we have forecasted our budget. Now I am going to summarize for you step by step what we are going to do. We collect the prior year's actual profit and loss statement. We calculated the average sales and average monthly expenses for the last year. Then we have calculated the gross profit percentage and the cost of sales percentage based on the last year date. It was 25% of our gross profit and 75% it was our cost of sales. Then we go and we determine the sales forecast. We have forecasted the sales and after that we determine which expenses are fixed and which are variable expenses. Then we calculate profit by deducting total expenses from the sales and also the percentage of net profit to the sales. After that we need to review to make adjustments to income and expenses if necessary. Means if we are going to increase our sales, so definitely our expenses will also increase, maybe our salaries or other things. So this all we need to go and we need to see exactly how much percentage we should increase our expenses also. Now we have finalized this our budget. You see how we have planned our budget. Now in the next slide we are going to see the variance analysis. Once the profit and loss budget has been prepared, it is important to monitor the variance analysis of budget versus the actual results. This will provide information on whether the business is on track to meet the goals or not. At the end of each month, the actual results from the profit and loss statement must be compared with the budgeted figures. Any variance will need to be investigated. This will help to minimize future variances. Now we are going to show you an example of how we are going to make this variance analysis. So here in the same Excel sheet we have budget versus actual variance analysis. What we have here, we have all the sales, okay, it is the main heading actual, okay, we have actual profit and loss for Jan, for Feb, for March, and the total amount. And we have the budget for budget what we forecasted before for Jan, Feb, and March. Here you can see we have forecasted that we are going to sell 325,000 and our sales will be but actual sales is coming 305,000 for Jan, and for Feb we have sales 325,000 forecast, but we sell 315,000. In the March we have same forecast 325,000, but we sell only 285,000. So here we can see that in total we are less 70,000 for the last 3 months, and for each month also we have shortage, but for the total we have the variance from budget, we are less 70,000. And also you can review the cost of sales. Here our cost of sales in the Jan, it is exactly coming 75%, and we forecasted our 75% will be our cost of sales. And in the Feb you see our cost of sales is increased 77%, and our gross profit percentage is decreased 23%. From 25 we are going down to 23% and 77%. So here you can see how much important this for the managers to review this variance. Where we are going short. We are going short in the sales. Also here in this month we have increased the cost of sales. Why? We need to investigate what is the wrong there. Okay, so same we have the expenses here, actual expense, all the actual expenses we have here 3,750 we forecasted in Jan, and 3,750. Okay, the rent is coming the same, we do not have any variance, but in the salaries we have the variance. So we need to see, we forecasted that we will have the expense 25,850, 25,850, 25,850, but why here 27,150, why here 26,150, why we are going up here in March also we are up. So actually 3,000 dirham we spent extra from our budget. Why we cannot control this expense what we have forecasted before? Where is the wrong? We need to see and rectify. We need to take proper decisions to avoid this variance in the future coming months. Also here in the utilities we are not going up. Here we have 195 less than the forecast. Total we forecasted 3,255 for the 3 months, but actually it is coming 3,060. So it is a good sign that we did not go up from the forecasted figure. But here again we are going up in the petrol, in the fuel. We need to investigate why our vehicles, what we have forecasted based on the previous year history, when in the previous year we successfully do our cost like 9,000 for the 3,000 per month. Why it is going to 3,150, 3,200, 3,250? Why it is going up? So all these figures again, here we have variance. Our cost is going up by 263 dirham, here 264. Okay, so this is the purpose of the variance analysis, that we need to see what we have planned our budget. Are we on track, or we are going up, we are spending more than the budget or not? So we need to take decision. We need to go, if there is sales problem, we need to go to the sales team. We need to ask them. If there is cost of sales, we need to go and see our production team, our procurement team. that why our cost of sale is increasing. And same for the expenses. For each person who is relevant, we need to go and ask him, we need to investigate. Okay, so this is the variance analysis. I hope you have learned something very clear from this video. If you have any question, feel free to ask in the comment box. To stay up to date with my latest video and cool accounting skills, make sure to subscribe my channel. Thank you.